What's going on, everybody? Happy Friday. We're going to get on board Levi Carter here in just a minute. Levi is the owner of CBFC Financial out of Oklahoma City. Let's get Levi on, and we will begin today's talk. So today we're going to be talking to Levi Carter. He owns CBFC. He's been a personal accountant of mine for the last several years, as well as the company and tons of CRNAs. So we're going to ask him some questions, have you all chime in on some questions, but he has some cool things to talk about as well. We'll see if we can get him on board. Levi's going to talk about QBI. He's going to talk about S Corps. There he is.
Hey guys.
Hey Levi, see if you can turn your camera or
Sideways.
your device. Yes, sir.
Yeah.
All right. Can you hear us?
Yes, I can hear you.
Thanks.
Keep my charger plugged into the bottom, so I'm trying to figure out how to stand this up here.
Yeah, man. Well, I'll give a quick rundown. I've already said a little bit about you, but you're my personal accountant, and as well as a lot of other CRNAs, and you do a lot for our company, CRNA Locum Jobs, as well. Levi, we actually met several years ago down in Texas, and we kind of continued our conversation for about a year before I jumped on board with Levi and his crew, and he is based out of Oklahoma City. He's the owner of CBFC, and they do all kind of financial things for you, your taxes. And I'll let you talk about that here in a minute, Levi, but it's so important for CRNAs who are doing 1099 work to have an accountant they trust and can work with, not just on an annual basis, but quarterly or monthly, or even if you have questions throughout the week. So Levi, if you want to give us a quick rundown of what you do and how you got started, then we'll start diving into some financial and tax questions.
Yeah, absolutely. Well, just quick shout out to CRNA Locum Jobs as well. Just been a fantastic partner to us, but just over the years, so many of your team has become good friends, and I've really loved seeing how CRNA Locums has really served a lot of our clients in just their career journey. It all starts with the income. There's a lot of more important numbers than income, but just that's where it all starts, and so that's a huge part of it. CBFC is a full-service accounting firm, white glove full-service accounting firm focused on tax planning for CRNAs. That's what we do. That's where we're going to provide the most value. We have a kind of a robust team of CPAs and tax attorneys and IRS enrolled agents, and just a really strong administrative staff that's just 100% focused on helping CRNAs create generational wealth by lowering this tremendous tax burden that they come to when they come into this wonderful income. So
Yeah,
that's what we do.
yeah, man, and you guys do a really good job at it, and the response time with you guys is always really good. I know I've been with other accountants in the past, and you may shoot an email or try to give them a call, and it may take honestly months to hear from them, but you guys are always within a few business days, and it's much appreciated. Before we get really into it, I wanted to make sure everybody listening and that is going to listen can be able to find you guys. So I know on our Instagram we have a link tree, and if you click on that, you actually see the link to Levi's website, CBFC, and you can actually click that CRNA Locum Jobs referred you to them. Please give us a shout out so Levi knows he's talking to one of the CRNA Locum Jobs fellow colleagues or locums. But Levi, is there any other way to find you guys? I don't know if you want to go ahead and comment your website or number, email, something like that.
CBFC, which is C as in cat, B as in boy, F as in Frank, and C as in cat, cbfc.co is our website. And if you could start there versus social media, it'll take you through kind of an intake where we can understand a little bit more about your locums, 1099 business and your numbers. So when we come to a call, we're able to kind of come with, able to do planning even in your discovery call. And so that intake form is really important. So just cbfc.co, and we'll drop it in the comments of this as well. And that's what's on the link tree as well. And my email is Levi, L-E-V-I, at levifcbfc.co as well.
Okay, thanks for dropping that, and thanks for joining us today. I want to go ahead and dive right into it. So obviously, locum CRNAs, for the most part, 99% of us are making 1099 income, and that's new to so many CRNAs. A lot of times, travel nursing, it's W-2, so coming into the anesthesia field, not being used to having your own company, getting a 1099, understanding what it means to file your own taxes, run a business, figure out healthcare, figure out the quarterly payments on your taxes. What am I going to do with retirement? All these things are so new to us because a lot of the schools, they may have maybe a class or two on business, but there's not a lot of information out there. So what I tell CRNAs is it's always not about what you make, but it's about what you keep. And I know that 1099 being able to be a locum or being paid 1099, you're able to keep so much more of what you make due to being able to run a business. So if you just want to start there, Levi, and give us a quick rundown of what that looks like to somebody who calls you a CRNA and says, hey man, I've been in W-2 for 3 or 4 years and I'm going to go locum, let's say starting in January. So in 4 months, what does that look like to me? I'm going to be 1099 now. What's kind of a 2 to 3 minute advice of what are you telling this person?
Yeah, so the biggest thing is, and I don't mean to make my thing the most important thing in this context, but the biggest thing that you have to realize is the math that you're taught to do when you evaluate whether or not you're going to go 1099 is you're going to evaluate this increased gross that you're going to get, and then you're going to reduce by, I got to pay for my own retirement. You're taught to, actually Michael's team or one of his providers has a great spreadsheet along those lines. I've got to pay for my own liability insurance, my own healthcare, and then you're kind of taught to see, do I come out ahead in that context? And one of the biggest things that's not factored in to that equation is that you now have control of your taxation. And you have to factor that number in, and it has a massive impact on your wealth. So I always tell people it's a no-brainer to go 1099 120% of the time if you're actually going to take advantage of the tax planning element of doing 1099 CRNA work. So if you're just going to not do any planning, you're just going to come drop your stuff on your 1099 on the desk of an accountant, in March, and you're just going to accept the liability like you would if you're a W-2 employee. That W-2, whatever it says you're paying in taxes, that's what you're paying in taxes. Then, maybe you come out a little bit ahead as a 1099 because the increased gross. If you have one of Michael's contracts, maybe you come out even more ahead because the increased gross, but that's actually not where the wealth building power comes from. So if you can actually do some tax planning and make sure you've got the right structure, the right retirement plans, if you don't like retirement plans, if you've got the right real estate strategies, if you're actually going to take advantage of that, well, that's probably going to make probably a $30,000 swing in your net income a year that's not going to taxes. And you throw that 30 grand a year in an S&P 500 calculator over 15 years, and you're an extra $1 million richer in the long haul being 1099. So the biggest key is finding the right partners. If you're not a DIY person, a full service solution like ours is great, but there's some CRNAs that have done DIY, great. Michael, I would say for, years as just a practicing CRNA was highly educated on the tax front. You ran your anesthesia practice before you also owned a recruiting company and did great tax planning all on your own. So you might be wired for, just nerding out on this stuff and setting up your own S-Corp payroll. But if you're not going to do that, and even if you did that, I would at least pay for some advisory hours with someone before the year ends. But if you're not doing that, like just looking for the right full service partner that's going to educate you, but also just do it for you.
Yeah, I heard you say something really important there. I do like the point, if you're going to do it yourself or have questions, at least pay for somebody to help advise you. Because we say all the time, we're experts in anesthesia. We're good at anesthesia. We can put you to sleep, but we're not experts in healthcare. We're not experts at taxes. So hire these people to help you out. If you have contracts you need to look at, hire an attorney to look at those contracts. It's a simple thing to do to take that weight off your back and put it in an expert's hands. But another thing I heard you say was the word you said escort. And so I think that's one of most people's biggest kind of hesitancy. They get into 1099. They say, I don't know, should I be sole proprietor? Should I be LLC? Should I be S corp? And can you tell us kind of the difference in the LLC, S corp, and sole proprietor, and what that just basic set to
Yeah.
be an S corp is going to save these CRNAs?
Yeah, so the sort of classic reason it's important to be an S corp or the savings opportunity you have is not income tax savings but FICA tax savings. If you clear 300 grand as a CRNA and you're just a sole proprietor, it's going to spit out a massive bill, but only part of that's income taxes. Most of it is what's called self-employment taxes, which is how the self-employed pay into Social Security and Medicare. That's usually the big gut punch. That usually people are factoring in income tax. Now, there's a lot of reasons we're going to game wages up over the years, depending on what your objectives are. For example, if you want to get allotted to your retirement plan, we're going to have to get your wages up. So there may be years where a CRNA might not have those FICA tax savings because we're going to jack their W-2 up to $150,000, and they're going to pay those FICA taxes on that, but there's a greater tax benefit because we're going to get $70,000 into their 401k. So every year that's there, but let's say it's not a big retirement year. We don't have a reason to jack up the W-2. We give them a $100,000 salary. Well, they're only going to pay that extra 15% tax on that amount, not all the additional FICA and Medicare tax savings on the rest of the 300 grand. Now, the other big piece of why that's important is S corps put you on W-2 payroll. And we're going to talk about this maybe a little later, but W-2 payroll helps you keep something called QBI longer. So there's actually a number of reasons why usually it's important for most CRNAs to be S corps. And then the one final thing I'll say on that is if you found this out too late this year, because you have until March 15th to become an S corp, and you're killing it right now, and you're a sole proprietor, we have a really high percentage approval rating on something called late S corp elections, where we go to the IRS and we say, we know we're late, but we've been functioning the right way. We've been functioning as an S corp, and we do back payroll to make it all look legitimate, and we'll get those approved. That late election, if you're having a great year, might save you 20 grand in FICA taxes. So we're pretty good at that, and we've kind of honed in that process. So that's available too if you're killing it this year and you pass the deadline.
Right. So I heard you say if somebody's making 300 grand, let's put their S corp wages, W-2 wages, because you're going to employ yourself and you're going to put that salary at 100,000. So versus being an LLC or a sole proprietor, with the Social Security maxing out, what is it this year? Is it 160? I forget what
yeah, it's above 150.
Okay.
So yeah.
So you're going to save at minimum that 50 to 60 grand in those FICA taxes. So that'll save you right there immediately, what, $8,000 to $9,000?
Yeah, and then Medicare is going to continue, so that's another 4%. And then when you get over, I believe it's 250, you have an additional Medicare 1%.
Okay.
So there's another 5 or 10 grand of savings there in the $300,000 scenario.
And I know we go over this. If you guys listening, Ed DeVoe and I do a financial session where we actually look at a spreadsheet to see if it's worth it to go from W-2 to 1099. But one thing we kind of hit on and we have in that Excel sheet is hiring your spouse or your significant other into your company. And what that allows us to do, or what it would allow you to do, is to give them a salary, deduct that from your wages, and they can actually start putting into retirement. So is that something you guys do often at your firm, Levi?
Yes, I would say we're frequently, especially in a heavy tax burden year, we're always looking to get more into the retirement plan. So we'll often max out the spouse. A lot of people have heard a lot of different reasons for putting a spouse on payroll. Generally, there's not a big tax benefit other than that, being able to give an additional 23 grand into their retirement. It doesn't really help from the income tax side because any additional money you pay her over or him over the 23,000 that's being deferred in the retirement account is just going to flow through to your personal return anyway. Unless you have a spouse that's concerned about paying more into Social Security, maybe they haven't paid in much or work part-time most of their life, then there's a Social Security benefit. But yeah, absolutely, we'll add them to payroll just to max out the 401k.
Yeah, that's always seems like a good idea, and you're able to contribute to not just one retirement, but two in retirements and save that money. Another thing too is I wanted to talk about QBI and qualified business income and how that looks for us being CRNAs, because on occasion I'll hear people say, "Oh, my accountant doesn't do QBI," or we're kind of hesitant to use QBI in the anesthesia world for 1099 income. What are your thoughts on that? And can you tell us what that percent is and what that looks like?
So QBI is a massive deduction. It's worth 20% of your net income. So imagine again the guy that clears 300K, that's a $60,000 deduction. So we can't lose QBI. It's too massive. We're talking about $24,000 off that person's tax bill. So we want to maintain, and you can maintain it. The problem is it goes away over certain income thresholds. And then without boring our audience with the boring rules here, there's also something for professional services. They're called SSTBs for QBI, and they even have tighter restrictions. So I'm subject to them as accountant, think accountant, doctor, lawyer, CRNA. So there's tighter restrictions there, and then but most of them are all surrounding income. So if we get under, we don't have to be subject to those if we get people under a certain income threshold. So one of the most important things we do in our fall tax planning sessions with all of our clients is QBI planning to make sure, hey, maybe we're putting this money in real estate or this money in the 401k, but what we want to do is we want to get them down beneath those AGI or adjusted gross income thresholds where they pick up the QBI. So then you have this compounding effect of, I didn't just say 20 grand on my taxes because I put 50 grand in the 401k, but I got back under the adjusted gross income line that I need to be at to pick back up QBI. Now, this is a manageable problem for our married CRNAs because QBI doesn't go away until I think it's close to 340,000 for a married CRNA. So they're going to have issues, or it's going to be hard for them to reach it. Maybe if they have a high earning spouse as well, a spouse that's making six figures on top. But generally, that's a manageable line to get underneath. It's very manageable. The problem is if you're a single CRNA, this is where we do a lot of heavy QBI planning. That threshold is around 200,000. So you can imagine that's a much higher benchmark to hit. So whether you're DIYing or meeting with a partner, that should be a big part of just kind of your fall tax planning is getting under that line.
Yeah, that's a really good, that's a huge savings, and it's an awesome reason why you should be, or you don't have to be a locum to be 1099, but if you can find a full-time job paying you as a 1099 contractor, it's a great way to immediately save money and save on your tax bill. One question I did have, going back to the S Corp, is we get this for people that are new to starting up their own company, having their own LLC or S Corp, and they'll say, I'm going to make $350,000, but Levi, you put me at $100,000 W-2 salary. So that means I'm only going to be making you X amount a month. What do I do with that extra $250,000? How do I pull that out? Is it easy to pull it out? How does that look for a CRNA who's S Corp and wants to pull more money out if they're getting $100,000 W-2 salary paid by their company?
Yeah, that's a really great question. The first thing to understand is that that's all your money, and that distributions from an S Corp are not a taxable event. That's not what causes you to be taxed. Actually, the government's going to tax those profits in your S Corp whether you pull it out or not. So usually now there's rare circumstances where distributions are a taxable event, but that's generally the case. And so that's all someone's money. So whatever your net income isn't meeting in your lifestyle from your net pay from your W-2 pay stub isn't meeting, you can pull those out in distributions. The one thing to be careful about is the IRS could come in and say, well, you're not saying yourself a reasonable salary if you have to take a distribution every 2 weeks. So you might want to do those irregularly. It might be better to take out 30 grand at once, and not take anything out for 4 months and then take 40,000 out. So that would look more like a dividend and distribution and be the extra conservative way to do it, but it's all your money and it's not a taxable event to pull it out.
Okay. So you can get that money just like you can get any of your money at any time.
Yep, absolutely.
Okay. I have this question a lot, and CRNAs as locums, they travel around. They may live in New York, but then they may travel to Pennsylvania or Ohio. They ask, and we get this question often, is where do I pay state taxes? Do I pay it in the state where I'm incorporated or I have my S corp, or do I pay the taxes where I'm actually providing a service?
Yeah, and unfortunately, that's going to be a state by state question, and a lot of our locum CRNAs are like we're navigating this with a lot of them, and there's something called income tax nexus. If you're real bored tonight and you can't go to sleep, Google income tax nexus, and if you nail it, call me and I'll give you a job. And it's actually not just, it's actually getting harder and harder to comply as more states pile on and more cities pile on.
Yeah.
So a lot of times these people move to a city, they didn't even know they're going to pay city income tax, which is a relatively new phenomenon in our country outside of New York and California. And so it's gotten harder. And so the answer may be different by state.
Okay.
Generally, I will not do anything if someone goes to Delaware for 3 weeks. And it's just not, we're just not even going to mess with it. But if we'll just have to sort of look at the income tax nexus rules state by state, and it's actually important to do it on 2 layers, not just on your tax return allocating some of your profits to that state because you were there for 2 months, but you actually, if you're paying yourself on W-2 and you meet those income tax nexus requirements, we actually have to set up the payroll accounts in that state. So I would kind of go, there's the right answer, and then there's the practical answer, which is, maybe don't even ask your guy the question if you're going to be somewhere for 2 weeks twice this year. But if you're going to camp out where for 3 months, you've got to kind of evaluate it.
Well, thanks for answering that. That's always a big question we have, and it sounds like there's a little bit of ambiguity there, and it obviously is state by state. So,
and the reason, Michael, you want to on the conservative end ask the question if you are going to be there 2 or 3 months, is where it would get caught is if that healthcare facility did a state 1099 on you. Okay. Then that state would be notified, and state 1099s happen sometimes. I think some state 1099 states look at them, and other states they just go in a magical digital pile somewhere and don't get scrutinized. But I have had it come up where 6 months later there was some sort of notification, and the CRNA said, well, how do they know that I was there? And it was a state 1099. So.
Right. Okay. So a lot of our locums, they're making anywhere from $300,000 to $500,000 annually, and they're obviously not using all that money to live on. They're not using all that money to put into retirement. They're putting a huge amount into retirement. I think you can get up to 65, 70 grand into one's retirement doing an SEP or certain retirements. But what are we doing with that extra money, and how is that going to help us from a tax advantage and from a tax standpoint? Like, let's say we have an additional $150,000 left at the end of the year. What is your advice? Do we put it into money market account and let it just grow 3 to 5%? Are we throwing it into the stock market? Maybe we can get 9 to 11% average on that. Real estate. What's kind of your advice for the additional money accrual when you're a locum CRNA, and what can you do to help out taxes?
Yeah, that's a great question, and I think the first thing that I would start with to answer that question is you have to start with kind of your do nothing number from a tax planning perspective, which is, hey, we look up in October, here's what we're going to owe, and you want to kind of get a feel on that number and feel on if you can live with it. The answer is almost always no. I can't live with this $75,000 number or $80,000 number. And maybe you did the solo K and that only gets you down to, or the SEP, and that only gets you down, you were at 90 and now you're only at 65 and you're still uncomfortable with that number. Based on your visceral reaction to the number, the amount of your wealth going to the federal government or the state government, you want to decide on, that's going to guide your decision where you put that money. Because some of the things that you just listed are phenomenal from a wealth building perspective, but they may not be tax advantaged. So for example, if I've maxed out my solo K and I'm viewing that as my long-term bucket, I can't touch that money for the most part. There's ways around that, but that's a long-term bucket, and I need to reduce my taxes, but I don't want something in a 59.5 bucket. I want something more in a medium-term bucket where I can build wealth, but I still want the tax advantages. Then for me personally, I'm going to move to the real estate strategies. Where can I put money in real estate? If you want to be passive, hands off, there's syndications out there. There's ways to do that. The key is, if you want the tax benefits, you need to be an equity owner in the asset. So a REIT won't do this. A REIT is just like owning another stock. You have to
Is
have
that like
equity.
being a limited partner?
Exactly. So if you want to be super passive, you can do a syndication. You be a limited partner. You're not signing on the debt. It's very passive. I do both personally, and I like people. There's advantages. I actually just had this meeting with our good friends Jason and Susan this morning. There's advantages, and we talked a lot about there's advantages to real estate you control, and there's advantages to real estate that you buy in partnerships. The advantages on the partnership end tends to be how passive it is, and also those asset classes, those big assets, spit out more depreciation than maybe what you can buy on your own. And I'll give you an example of this. We did with a group of clients, a group of car washes a few years ago, where we put a $1.5 million in on a $4.5 million purchase, and on our $1.5 million in, it spit out $3 million of year one depreciation. So we put $1 in and got $2 back in depreciation. And so you're not going to get that maybe in something that you can do on your own. So those tend to be the pros, but there's a ton of additional benefits to real estate you control. You are going to pick up some of the tax benefit, and you can refinance that and pull that equity out at will. You're not subject to a general partner's direction. You can sell it if you need to and pull the equity out that way. And so I generally move, if we still are not at a tax number that we like, I generally move from the retirement plans to the real estate. Or there's a lot of CRNAs that are real estate only. There's whole Facebook groups of CRNAs that hate retirement plans. I tend to be both. I know Michael's both. I think there's pros and cons, but I'm going to move there first, and then probably third to the things that are great from a wealth building perspective, but not be tax advantage. Both Michael and I have taxable brokerage accounts where we just dump money in the S&P. That's a great place, and it's not locked away forever. It's not like the 401k. So I'm probably moving last to that in a year where I don't like my tax burden.
Right. So I don't want to confuse the audience too much because this gets a little complex,
Yeah.
but there's such things as real estate professionals, and then you can also buy short-term rentals at, Airbnbs or furnished finders, and you could actually roll those into your Schedule C and not have to be a real estate professional. So there's all kinds of strategies and ways to buy real estate without being a real estate professional, but still get those deductions and benefits of tax savings. Is that right?
Yeah, and I won't go too deep into the weeds. One easy way is, because I know it gets technical, but what Michael's referring to is passive loss limitations. You can't just take a passive investment loss against your ordinary income, which is your CRNA income, your earned income. And so one of the easy ways, if we can't qualify a non-working spouse as a real estate professional for some reason, or maybe they work too many hours part-time somewhere, is we can flip the script on this, and we can actually make your partner a passive 50% owner in your S Corp. So those earnings are not passive to you, your CRNA earnings, but they're a passive partner. My wife is a passive partner in our accounting firm. She doesn't have to do any math. I do all the math. So now what we're doing is we're transferring half of our earnings into the passive bucket, where I have this passive loss waiting for me because I invested in this apartment syndication and it spit out 60 grand of depreciation. Michael loves the Airbnb strategy, and those costs segregate really well. You got a lot of furniture, a lot of short year class lives where we can depreciate those things very quickly. So there's lots of workarounds, but it's just like the QBI conversation. We can't have any of these conversations in January. now's the time to kind of dive into that and figure out how we're gonna
Yeah,
structure
yeah, a
everything.
lot of strategy involved in making sure you guys keep more of what you make. And again, it's not about that top line, it's about that bottom line of how much are you actually keeping at the end of the year and not giving to taxes. You know, if we can do real estate or different types of, you have your spouse on board of your company, there's all kinds of numerous ways, and Levi's crew can help you with that. But there's so many ways that you guys can save on your tax bill being a 1099 independent contractor, and I think it's awesome. I did want to go through a couple of these questions where we have about 5 minutes left, Levi, but I've seen some questions roll in. One said, how do I incorporate a Roth IRA when earning above the limit as a 1099 contractor? I think you can give a pretty easy answer on that for us, Levi.
Yeah, there's I'm going to try to. It's tempting to give you three easy answers. One, you can do a backdoor Roth. You can Google that tonight. You can contribute to a traditional IRA. We can backdoor into a Roth. A great other easy way is if we set up your 401k, you can do 401k Roth deferrals of your salary. And then the third is I encourage high earning CRNAs to plan a Roth year. If you want to reach some goals that are not going to help you for your taxes today, let's figure out a way to get a low tax year. Maybe you take a couple of months off. Maybe you have a big carry forward real estate. That's a great year to do a big Roth conversion. That's a great year. I get mad at Michael because of his tax burden. He always pays off debt with his money. That's not a tax deductible event. So let's plan out that debt repayment year or that Roth conversion year where we know we're going to take the tax hit, but somehow we got it down, or we worked less, or we figured out a way to get it down. So we're taking the Roth hit of taxation on that rollover in a year where maybe we're not in a 42% bracket.
Okay. Great answer. Thank you, Levi. While we're still talking about the Roths, we had another question that said, what income level do you like to go from a backdoor Roth IRA to a simple or a SEP IRA? So is there an income level where someone has a backdoor Roth and then they want to convert that to a simple or SEP? Because those are two separate
I think
retirements
they're
there.
kind of alluding to, I want to do SEP or traditional 401k in a year when I'm paying a lot of taxes. So that's when I want to do, and it's alluding to the same concept as I was alluding to. I don't know that I have a concrete benchmark there, but certainly when there's sort of a visceral reaction, multiple tens of thousands of dollars going to the government might be a year to consider that. And I always temper the advice of financial advisors on Roth products. A Roth product will always, on paper, that tax-free compounded growth, it will always beat all of the traditional products. So one thing you need to keep in mind with your financial advisor is there is a high chance, and I work very closely with a lot of financial advisors, they're my great friends, but there is a high chance that financial advisor is not in your income tax bracket. And so it's really easy to put something on a spreadsheet, but you're going to be one writing the $70,000 check. And so you've really got to manage, okay, am I comfortable with this number? What could I do with an additional $30,000 that Levi's saying I could save if I put it in a traditional product? And that is me as a pro Roth, person, 100%. I know how the math works, but I may be closer to your income tax brackets than your financial advisor. You got to factor that in.
Thank you, Levi. One more here. We got asked, if I'm going to work or take different assignments in several states within a year, is it better to go S Corp or LLC route? So they're wondering if the S Corp may eat into tax savings because they're opening and closing payroll. Any thoughts there?
Yeah, there is a chance if it's a multiple, you're still going to have, I would do the best thing from a global taxation, which usually means federal taxation standpoint, which is probably going to be S Corp. You're right. You may have a couple of different payroll accounts and you may get a surcharge on accounting for that. But even without that, even as a sole proprietor, you're still going to have multiple state income tax returns. So it's not like you're getting rid of all of that multi-state accounting because of that, just the payroll multi-state. So there's generally enough savings between QBI and FICA tax to generally justify being an S corp.
Okay. Thank you, Levi. Oh, here's another one. W-2 with full pensions get great healthcare insurance versus 1099. I guess that's really something I tell people a lot. You have to do what's best for you and your family, so look at all options. But still big on the 1099. I know you really enjoy the 1099 too, because there's so many variable ways to put into retirement to kind of match that pension or to do better than what that W-2 pension is giving you. And there's a lot of good private healthcare insurances out there too. That's a pretty big question we get really common is I don't know what I'm going to do if I don't have healthcare insurance through my W-2 job. Well, there's a lot of really good healthcare companies out there that we actually recommend as well, but that can help you find private insurance. And really, it is more expensive, but I feel like a lot of W-2 jobs nowadays, healthcare for your whole family it seems like it's running up into the $300, $400, $500, $600 a month for W-2 employees. I don't know if you're seeing that on your end as well, Levi, but healthcare is expensive, whether you're 1099 or W-2, it seems.
Yeah, absolutely. As always, Michael's right. I won't add much to that, but yeah, I would make that decision by compounding $30,000 a year of tax savings into that S&P 500 calculator, and just see how much wealthy you are in 10 or 15 or 20 years. And I know 30 is probably a random number, and I should dial that in, but that's where the true wealth comes in: control of your taxation.
Well, thank you, Levi. We'll do this again for sure. I know we've probably barely scratched the surface of all the things 1099 and what we can do as CRNAs, whether you're a locum or a full-time 1099 independent contractor. There's so much information out there, and there's really great people like Levi and his crew at CBFC. And again, we're going to throw his website in the comments here, but if you guys are on Instagram, if you go to our link tree, you can go to the link tree and then you'll find his website there. Contact him and his crew. They're awesome. Levi's brilliant. He always has new things to come up with, and new things in our tax planning sessions. And I'm always amazed with how intelligent you are. And I feel like you always stay up to date on all the latest things too. Did you get to go to a conference this year?
Been to a few. I'm looking for one on the beach, one CPE conference on the beach before year end. I'm always looking for a vacation CE conference to go to this time.
Yeah, that's a deduction, right?
Absolutely.
Sweet. Well, we'll do this again, guys. Get in touch with Levi. Get in touch with us. We can hook you up with his crew. But again, 1099, you want to be able to keep more of what you make, and that's what's most important at the end of the day. But thank you so much for joining us today, Levi.
Yes, thank you guys. Thanks, Michael.
Okay, bye-bye.